George of the jungle, strong as he can be.
Are stated income loans making a comeback? Boy, is this a rewind of 2007? I don't know, but that's what we're going to be talking about in thecreditjungle.com today. This is George Anderson, and thanks for joining. I was at a sales meeting today with a group of some very experienced real estate agents, and one of them brought up a scenario that I was like, oh yeah, I know about that. And they're like, why didn't you tell us, George? We have clients that would do this stuff. But apparently the agent has a friend who is purchasing a home in Wyoming, and they are purchasing that home as a rental property. The buyer for that is unemployed. They don't have a job, haven't had a job for several months, not looking for a job, maybe not even looking to get back to work if they don't have to. But the woman has good credit, and she has a significant down payment, and she was looking to pick up an investment property. So we're going to talk a little bit about what are called QM loans versus non-QM. So QM means a qualifying mortgage, or in other words, the agencies, Fannie Mae, Freddie Mac, Ginnie Mae, they have debt ratio requirements, income verification requirements. And this was all designed as far as, as part of the Dodd-Frank overhaul of the mortgage industry that began in 2008 and actually was phased in over several years. And the idea is that they don't want to get people into homes that they can't afford, okay? And that makes perfect sense, and I completely concur with that. I have my own opinions on what that's actually done to the mortgage industry. I'll save that for another video. But the idea is that those are for primary residences. If somebody is looking to buy a home as an investment property, well, then there's a different set of rules that apply because these are non-qualifying mortgages. And there's some a little bit more detail to this, but I'm going to go into just one type of loan today, and we're going to talk about some loans that, instead of trying to figure out how to qualify people for the loans that we always talk about, which most of my videos up to this point have been educational videos, I think it's okay that I'm going to, maybe for 3 or 4 videos here, I'm going to go into the selling money mode. Don't always like to do that, but since there was a lot of interest and there were several questions that were asked at this meeting today, I promised them, I said, okay, I'll put some information out about these types of things. I'll post them on your company's website, and let's have a discussion. So the first one that I want to talk about is a debt service ratio program. And what that means is that if somebody's going to purchase a rental property, apply some common sense here. If you know that your mortgage payment is going to be $1,500 a month after you buy this house, but you don't think you can rent the property out for any more than $1,500 a month, that's not a moneymaker. That doesn't make sense to do that. So the only reason that somebody would purchase a rental property is because they're fairly convinced that they can rent the home out for more money than what the mortgage payment is. And so if you thought that cash flow, and maybe you figure that, okay, if I can rent it for $2,000 a month and my payment's $500 a month, and maybe I've got $50,000 of income out on here, that's going to give me maybe an 8% rate of return on my money. Well, you know what? That's probably a safer investment than having it in the stock market. It's a greater rate of return than what you would get putting it in a CD or a money market account. And the other thing with rental property is that you also have a couple of other very tangible benefits. One of them is that you get the appreciation value of the home going up in value. In other words, it's not a stagnant asset. In other words, while you're generating that cash flow, the value of the underlying asset is probably going to continue to go up. The other thing is that when it comes time to file taxes with depreciation and different types of improvements and stuff that you would make to the property, you might also be able to make that money that you're making could be tax-free income. So there's some very significant benefits to that. But anyway, on a debt service ratio loan, you as a person, as the individual purchasing the home, do not have to verify any income. Now, does that mean we're not verifying income? We are, but it's not from you as a person. It's income that's going to be verified from the property. Okay? So there's going to be an appraisal done. And on that appraisal, because it's investment property, the appraiser is going to include 2 additional forms on that appraisal, and that's going to become part of the underwriting. So in other words, we don't care about your income. What we want to do is we want to look at a profit and loss statement, basically an income operating statement on the property, which is called a Form 216. And that basically says, here's what the anticipated expenses would be on this home based on age and, some different factors, the condition of the home and whatnot. That becomes part of the appraisal report. And then the other thing that goes in there is Form 1007, which is a comparable rent schedule. In addition to the comparable sales data, which would tell you what the value of the home is, the comparable rent schedule allows the appraiser to look at other properties in that neighborhood that are similar to the subject property, the home that's being purchased, and what is the amount of rent being generated off those homes, and how would, with some adjustments, that translate to the rental income on this one. So if there's cash flow there and you're getting rental income, then they say, hey, this property is going to cash flow more money than what the payment is. You have good credit. You have a large down payment. We give you the loan. Now, oddly enough, if your credit is good enough and if your down payment is large enough, you only have to have a 1-to-1 ratio. So in other words, if the property is going to cash flow $1,500 a month in rent and you have a $1,500 payment, you can get the loan for it. But again, they're just looking at your capacity with having good credit and having a down payment. Now, these scores on some of these programs can go as low as 640, but there's going to be adjustments for the interest rate, which means that the payment's going to go up, which means that the cash flow is going to go down, and you've got to take a look at some of these numbers and make a really educated decision before you get too far into it. But the nice thing about it is that it's a very simple, easy documentation program. We're looking at the assets, we're looking at your credit, and then we are looking at income, but just the income from the property. Now, just a quick other thought on this is that these are not fix and flip loans. These are loans that the investor or the bank wants to hold on to them for a while, so they have a prepayment penalty. The standard prepayment penalty is 3 years on these. So this is not the type of loan that you want to get if you're going to buy a property, fix it up, and flip it, and hopefully sell it within 6 to 12 months. I'll talk about those types of loans, and there's actually a very, very clever way to acquire those properties. I've done it myself, and I've helped a lot of other people coach them in how to do it as well. But if you're looking at investment property and you yourself don't have the income, but you have good credit and you have the assets, this might be a great way to supplement your income with a good investment property. So hopefully that makes sense. Get Mortgage Professional, and I'd be happy to help answer any questions that you might have. Have a great day.